British American Tobacco,
Yes.
biggest company listed on the JSE. Results out yesterday. Of course, it's not the top 40 company because it's one of those inward listing companies.
Yes.
Shares didn't respond positively to those numbers, although the numbers didn't look bad.
No, the number's not bad. I mean, first of all, BAT has got a, I don't even know how big the market cap is, but it's huge. It's 500 billion odd rand. But it's an inward listing, so it doesn't form part of our index. And if you look at new legislation that's come out, the Regulation 28 specifically, it doesn't look as though it's ever going to form part of our index. Now, what that means is it's got to form part of your overseas allowance. So it is at the end of the day.
Company, yeah.
At the end of the day, it's an offshore company. It needn't even be listed here, and you can just trade with your overseas money in the London stock market if you wanted to. Okay, this is a cheap share. In my view, it's a very, very good company, but it's not a cyclical company. It's a very stable company. So this is one you buy when times are looking tough, not when you're in a recovery phase, and hence it has underperformed. But on a 5-year view, this is a very cheap company. It's a very good company. Why did the shares not react positively to it? Everyone knew the sales were down. Sales were down 3 or 4%, about 2%. If you look at like-on-like growth, but everyone knew that. Profits were good, margins extremely good. People are trading up on the brand, so the margin was very good. But the real disappointment at the end of the day was the share buyback program wasn't as good as what people expected.
So people were expecting a larger share buyback program.
Yeah. And these companies, tobacco companies, generate massive amount of cash. Their rationalization, their cost cutting has been better than expected. I mean, I think they've cut 800 million pounds out of the business, or 800 million euros, I can't remember which one. But the cost cuttings exceeded expectations. So it's a very, very good company. Just that in an economic recovery, this is a laggard. Same as when things fell off a cliff a couple of years ago. This was one of the best shares to own.
You mentioned this inward listing status unlikely to change.
Yes.
There was a concern that some of the other big 5 companies that are dual listed, our Anglo-Americans, SAB Millers, could lose their South African listing status and become inward listings, but that seems to have dissipated.
Yeah, that seems to have dissipated. It just seems to be BAT, which of course gives Renet a reason for existence. You can buy Renet, which is BAT, without using your overseas allowance. But I mean, overseas allowance.
But they're paying those large management fees. That
no, we know all about that. But you know that when you buy the share. Yeah. So if you don't like it, don't buy the share. But yeah, it gives it a bit more of a rationale for existence, and you can buy it, as I said, without using the overseas allowance.
Just finally, Liberty results yesterday. There seemed to have been a bit of a mixed reaction to those numbers. So although there was a strong rebound, it was coming from a very low base the previous year. Lots of analysts saying Liberty lacks some of the innovation we're seeing in some of the other life companies.
Yeah, look, Liberty, this was the darling share of the 90s. It was the bluest of blue chips, and it just shows you how things can change. I mean, Liberty has massively underperformed the market, but maybe we're at the bottom now. Our analysts, and we certainly think it's cheap. We've got lots of Liberty, and the share price movements over the last couple of weeks since that last trading update and the results have actually been quite good. So I mean, today I think Liberty's up just under 1% or just over 1%. So it actually looks quite good, and we're still holding on to it. Not because Liberty itself is doing something different or something innovative, just the share got too cheap, and life companies are heavily geared to a share market recovery, which is exactly what we've seen now.
Would you buy a life company generally, though? Isn't it just a proxy to the market?
It is, at the end of the day, a proxy to the market. Now, our actuaries will argue like crazy with me that it's not, but a lot of the fees are still based on assets under management, i.e. the more the market goes up, you charge a percentage fee on that, so you make more money out of it. And of course, when the market goes up, generally people want to buy some more because they see good returns, so your volumes go up. So it's not as geared as what it used to be. In the 80s and 90s, these were almost total marketplace, so not as geared as what they used to be, but they are still, at the end of the day, a rising equity market's good for life insurance companies.
Wayne, thank you very much for your time.